So hi, this is Sherron again, the Modern Savvy CPA with the second half of our debt financial literacy topic. And I have here with me, I have Nick, which I will butcher his last name, so he'll tell you guys.
It's great to be here with you. My name is Nick Anaspigian, and I am a mortgage loan officer here in Wellington.
So Nick is, I've known you maybe 5 years?
Close to that, somewhere around there, yeah.
Nick is my mortgage guy when rates were super, super low. He took care of all of my properties. He takes care of my friends' properties. He takes care of my family properties. He's like my guy. So when I trust you, you're it. So I thought I would bring him on the show today because I ask a lot of questions when I'm doing something, and he's always very knowledgeable and able to answer my questions and analyzes things that I don't that he might not have the answer right away for me. So I'm tooting his horn.
Well, I'm honored to have been able to help you and be in that position to assist and answer all those questions, because there's a lot of variables in the mortgage world, and unless we're discussing them and going through what's best for your scenario each time, it might be slightly different.
Yep.
There's a lot of things left unsaid, so it's good to ask questions in the mortgage world.
And our goal is to be financially lit, and that's what my passion is to make sure that everybody understands what's happening, and all these things affect them. You might think that, I'm not good with financials, but you need to be, because it's part of your life.
Yeah.
So that our goal is to make sure that everybody understands what's happening. Getting a mortgage or owning your own home and dealing with debt in general is just part of everyone's life. Mm-hmm. So on the first part of the show, which Nick also was sitting outside, so he doesn't know what I said on the first part of the show. So on the first part of the show, I went through debt, revolving debt, non-revolving debt. I went through unsecured debt, secured debt, and things like that. So just basic topics on those things, advantages and disadvantages.
Yeah.
So what you're like I said, what you're going to go into is secured debt, which one of the main part of it is mortgages. And you're going to kind of explain to us a little bit about mortgages. So we did some little testing of our questions, me and Nick, before, of course, you have to do your homework. So one of the first questions I'm going to ask Nick to talk about is cash planning and budgeting. What are the differences and similarities when it comes to cash planning, but what does that mean?
Yeah, well, for me, cash planning in the mortgage world, I kind of look at that as the preparation stage for making sure that you've got enough cash, you know where it's going to be coming from. Because in the mortgage world, you can draw from your savings. You could take money from you could have stock investments that you liquidate. You can take it from your retirement account, or you can get it in the form of a gift. But the cash is a no-go in the mortgage world. And I was just talking with somebody on this today, and I said, hey, I took it out of this account, and I'm going to put in that account. And once it's cash, it's hands off on the mortgage side of things. So cash planning and knowing where the funds are at ahead of time before you need them plays a huge role.
So let's elaborate on what do you mean by cash. We were talking
green
about
pieces or other colors now, green pieces of paper. The physical cash, that's where the government has over time realized there's a lot of things that can be done in real estate that are not desirable. So knowing where exactly the funds are coming from for a real estate transaction is super important. So in the mortgage world, when we see cash deposits, everything needs to be sourced, and cash deposits inherently can't. So that's where planning ahead of time and knowing that, hey, I've got X amount of funds in this account, and I might be getting a gift from a family member, which is super common. All of those things come into play when it's coming time to make that purchase.
And globalization is here to stay. So we're living in America, but we have family, friends, people all over the world. And one of the things on the tax side of this is that it is more strict on where the money's coming from. Americans who are getting money from out of the country, there are forms and there are so many things that you need to fill out to regulate that. Foreign buyers are getting hip to FERPTA and things like that. So it's when Nick said cash, I just wanted you guys to understand what cash is.
Yeah,
and it's the green pieces of paper.
Yeah, it's a good thing to plan ahead on, and then there's the budgeting side of it, and that's where I can get somebody approved for a loan, and they could, hey, congratulations, you're pre-approved based on the amount of money you have in the bank and your debt to income ratio. Maybe somebody could buy a $750,000 house. But if they don't want the payment that's associated with it, that's where budgeting comes into play. I always try and understand what a buyer's goals are. There's the comfort payment, the stretch payment, and the it's not going to happen payment. And those are good to identify.
Of course, yes.
Because there's times when somebody might just say, and almost have their blinders on and say, this is the house, I can qualify for it, I want it. They buy it, and they might be stressed about that housing payment. And you can get caught in a bad position where you're not going to enjoy that beautiful house because that payment that obligation's eating at you every month, thinking, I got to make that. So there's understanding that the desired budgeting outside of the qualifying part is really up to the homeowner or the buyer in this case, and having that understood is super important.
So all along my financial literacy top hot topics this series, I've been talking about your comfort level with money and comfort level with what you buy. You think about what you're doing with your money because you want to make, we talked about the guy who bought $20,000 worth of furniture from an expensive furniture store, and now he's freaked out about that and he's worried about the Costco bill. So, you think about what you're doing and make sure that when you're spending your money, you're comfortable with what you're spending. Because you think you can afford it, that does not mean that you're comfortable with it.
Yeah, and a house is an aspirational purchase for many people, to where that might get muddied,
It's emotional too.
Emotional, aspirational, to where, you got to think about it with a sober mind and identify that personally, of, hey, where are you comfortable at? Where is it going to be a stretch? But you can look at it as an investment, because your house is an investment. And then, you have to know that point where I'm not going to be in a good mental state if I have a payment this high.
Because ideally, we do all of this. Our finances are supposed to make us comfortable. That's the reason we're working, the reason we're investing, the reason we're building wealth is for our comfort, contentment, and happiness.
That's right.
So if it's having the opposite effect on you, you are doing something wrong, and you need to educate yourself. You need to be financial literate so you can keep working at being comfortable with where you're at with your money. So we're gonna go on. We're gonna talk about how does other debt affect your mortgage and your mortgage debt.
Yeah, it's a good question, and I get this question a lot. Somebody will call me and they'll say, "Hey, we're thinking about buying a house," and I had one guy. His car got damaged in a storm, and he said, "I'm probably going to have to buy a new car, Nick. Well, how does this affect me? My other car was paid in
off.
full, but I'm going to need to finance the new one because it's not worth much anymore." And it could affect you greatly. It might not. So everything with a mortgage, whether it's a $50,000 loan or a $4 million loan, comes back to, and I think I might have said it earlier, the debt to income ratio. So we're gonna identify the borrower's qualifying monthly income, which isn't always what you're taking home in your paycheck, because they treat different pay types differently. So we come up with a qualifying monthly income, and then we'll look at what's on your credit currently. Credit score is important, but this is the debt payments, the minimum monthly payments. So you might have $100 of minimum credit card payments, and it's still going to show up as a minimum, even if you pay them off every month, because it's going to report and say, well, Nick has a $1,500 balance on his Capital One card, and the minimum payment's $50. So that's on my ratios. So if somebody has really good income and low debt otherwise, that answer for that guy could have been, hey, if you want to go get a $500 a month car payment, it's all good. If you're not pushing it up, because we combine new house, other debts into a, combined monthly payment obligation. And we just compare that to your monthly income. So as long as he's not bumping up against the limits, which in a perfect scenario, you can go up to roughly 50% of your monthly qualifying income, which is pre-tax, and all of that, we're okay. But it's something where there is no like hard line, but it's other debts really do affect it. And, if you have a large car payment, housing payment wise, let's say you had a $700 a month car payment and you did need that to get into your qualifying limit. $700 a month for a car, using a rule of thumb, that's about $100,000 of purchase price on a house. So it's something to consider. And this is where, obviously certain things you can't change in a month or two, but forward thinking and planning, like Sherron's teaching, is super important.
So let's talk about car payments, because a car payment can make or break your chances of buying a home.
Sure.
Right?
Yes.
Because I've been seeing this all the time. First of all, a car is not an investment. Let's just get that out of the way. A car is not an investment. We live in America. You can furnish your home from Walmart for a couple of $100 with dishes, with knives, with cutlery, with everything you can think about. Or you can furnish your home from Saks for a couple of $100,000. The same amount of things, they do the same things, but it costs different. So my point of that meaning is we here live in Florida, right? So we don't have much public transportation. I'm not a big public transportation person anyways, but we don't have public transport. So we need cars. We need our cars, right? For the most part, we need our cars. Now, where the comfort level comes in and the keeping up with the Jones level comes in, and what do you want when your planning comes in is what kind of car and what car payment will you get. It's not what you can afford when it comes to the car payment. This is a choice. You need a car. You want a Mercedes Benz. Big difference. So
I'm an Audi guy, but
Well, Nick can afford his Audi if that's what he wants to do.
I don't have one. I just like them.
Okay, good. But I'm not saying you don't buy your Mercedes. I'm just saying you need to prioritize. What are your plans? What are you financially literate to understand what are your long-term goals? If I don't have my home or my first home yet, my car is going to be bare minimum taking me where it needs to go, because it's not an investment. It's a necessity for me to have a car. And that is and I won't even tell you the kind of cars I've had going back to 16, 17, 18, 21 years old, and what happens to the cars. I had one that flooded in the back every time it rained, and I couldn't figure out why, because there were no holes. So we've all went through our times, but I'm not buying a Mercedes Benz because I don't live in my car. And until I have my home that I'm going to be living, whether it's my first home, my last home, whatever home it is, that's my first investment. A car is not an investment. I'm not going to pay $1,000 lease for a Mercedes when I don't have my first home. So you have to prioritize. If you think the car is what it is, it's not an investment. It's you decide. It could be a $300 payment, a $3,000 payment. You need a car. What kind of car you need varies from Walmart to Saks. That's just it.
Yeah.
So that definitely, I've seen people where their car payment, so that's the other question I wanted to ask. How does the lease payment versus a car payment that you own affects your mortgage? Does the payment goes into your?
It's all treated the same with the exception of one thing. So on a car payment, if you've had the car for the majority of the term of the loan, so let's say most people do a 4 or a 5 year term, right? So let's say you did a 60-month car loan and you were nearing where your loan's going to be paid off. Once you have 10 or fewer payments remaining on a loan, we don't care anymore.
Yeah.
We ignore it.
It's almost gone.
Yeah, so you don't need to go paying it off, and that's something that people ask me. Hey, should I pay this off? Should I pay that off?
That is a good tip.
And I usually tell them, let's get a picture of everything first, because you can put
that money down.
10. Let's say, you could put $5,000 towards your car payment that we would have ignored anyways, instead of saving that $5,000 for something else in the loan where it really could have had an impact. So there is no like all debt's bad, pay it all off before you start a mortgage, because like in that instance, that $5,000 might have been able to use towards something else which would have helped you qualify. Right. But yeah, leases, even if it's nearing the expiration, we leave it, because the assumption is if Nick has a lease,
he's getting another one.
He's got to get another one, or else he's going to walk, and he's not going to walk. So, so the leases, the leases stay, and the car loans you can exclude once they're within 10 months of their.
I did not know that.
Payoff,
That's a good tip. That's a good tip. So the other thing I'm hearing from Nick is you really need to speak to an expert when you're planning, these things, and you ideally want to go to Nick. When do you ideally want to go to Nick? In terms of your planning for home buying?
I take calls from people all the time. There's some people who are ready to go right away. There's other people who are a year or more out. And I think as soon as you start thinking about seriously purchasing a home, as long as you're dealing with a loan officer who's in it for the long haul and for the right reasons, there's productive conversations to be had along 2 years out. Even it's an introductory conversation. To say, talking with a self-employed individual, right? They might say, "Hey, I make $100,000 a year." That's what they think. Taxes might not reflect that. And having that knowledge 2 years out, they might get that from their draws from the business, but we don't look at that.
Right.
So, earlier the better. And it's, if you're talking with a professional who's interested in actually helping people and giving them answers, understanding what's my qualifying income, because I've talked with salespeople. They're W-2 employees, not self-employed, and they're killing it in their mind. But they might not have been on the job long enough. They could be making $50,000 a month in commission. If they're not on the job long enough, doesn't matter. You qualify with zero. So it's having those conversations to understand where you fall in the qualifying income and your debts. There's never a bad time to start if you're interested, because you can get those answers and then you can plan from there.
I heard a few awesome tips from you. One is understanding what you should pay off, what you shouldn't pay off. I like that. I think that's a great tip for potential homeowners to look at. I did not know that one, and I've been doing this for a while. I like the planning. What I hear from you is planning. If you're potentially looking, whenever you're potentially looking, start as early, start with someone. You also build up a rapport. You understand if that's the right person you should be working with or not.
Yeah.
When I talk to Nick and him able to answer all the questions, talk to your people. Don't just email them. Make sure you have a first conversation. Yes, you can communicate many different ways, which we all do, but initially having that first conversation is important. You don't have to see him to talk to him, but you should have that conversation with him so you can get a good rapport. So you talked about self-employed individuals and what kind of paperwork, tax-wise, what are they looking at? Give us a little tidbit on that.
So typically a self-employed individual, the kind of rule of thumb is that we need to see 2 years of tax returns. And that is true. 2 years of tax returns, we're going to look at those, and we're going to look at the net income of the business. So, and it's not uncommon to talk with somebody and they'll say, my business makes $500,000 a year. That's the revenue. And then you have expenses. And so we look at the net profit of the business. And if you pay yourself a salary, that's obviously going to detract from your net profit. But we add that back because that's a benefit to you. So we're going to look at that. But in certain instances, if you've had your business for a long time, for certain loan types, we can go off of just 1 year and not 2 years. Government loans, we're always going to need 2 years, but certain businesses, they can go off of just 1 year of tax returns. You still have to have had your business for 2 years, but there's some good options there. when it's an established business.
Right. So again, I hear planning and talking to the right professional that can give you the right advice. So, you don't wait. The saying I've been hearing lately, oh, I'll cross that bridge when I get to it. Well, like I said before, when you get to that bridge, and the bridge might be washed out and you won't be able to cross it. So you need to make sure that you are supporting that bridge, and you need to make sure the bridge is there, and you need to make sure that it's not rotting. So the way to do that is planning, getting yourself financial literate, speaking to the right advisors, and making sure that you're planning. So we went on. Well, let's talk a little bit more about alternative documents.
Yeah.
When it comes to a mortgage and a loan.
So there's a couple. I said everybody qualifies off the same thing: debt to income ratio. Little asterisk.
That's the first thing.
Yeah. Small qualifier there. Most people. And there's some other ways to do it where you can do alternative documentation instead of tax returns. So if somebody's self-employed, you can qualify off of the monthly average revenue into your business. And this is a good way if, like, for an example, you have a business that is growing a lot and there's a lot of expenses, right? It has plenty of cash flow. It's not at risk for, being insolvent, but taxes don't reflect a lot of profit. So in that scenario,
I can attest to that one.
Sure. So in that scenario, you can do it's called a bank statement loan. We're going to look at 12 months or 24 months of the business bank statements, and we're going to average the monthly deposits, and then they'll come up with a imputed monthly income from that. Alternative to that, if you have quite a bit of money, you can do what's called asset depletion. That is a lot of money. So that's rare. And then the other one is for investment properties. There's something called the debt service coverage ratio loan. And we're not going to look to see if Sherron is leasing a Lamborghini. We're just looking at the property. So say you want to buy a rental property, and it's the monthly payment is $2,500 a month. The appraiser is going to go out and say, all right, well, is this house worth what you're paying for it? Yes. The next step they're going to say is they're going to look at the market rental comps. And as long as the appraiser's estimate of monthly rent is the same or greater than your monthly payment obligation, that's good to go. We still look at credit score. We make sure that you own a primary residence, and we look at your assets. But we're not looking at Sherron's income. We're not looking at her other monthly obligations. It's approved just on the cash flow of that property.
I like that one.
Mm-hmm. You're going to pay a premium on some of these loans, like the bank statement loan. There's a little bit of a premium on the interest rate and on the fees. But the alternative is you go to the bank of cash. So there's options for many different scenarios, and lots of ways to get it done.
So that's going back to the first half of the show when I said if you don't ask the question, you won't get the answer. If you sit on the couch and you don't ask the questions, that's basically telling yourself no.
Yeah. Well, and it's to qualify that, it's asking the question, knowing the questions asked, but like as a personal example, a few years ago, I was looking at an investment property, and this was a scenario where, and this was many years ago, I should say, I wasn't in the mortgage business, and I didn't know about that, but I had a lot of money in the bank, and I didn't think I could qualify for it. And I talked to a mortgage lender, and they said, no,
You qualify.
Yeah, no, they said no, because I had a different business, and, and they said, there isn't the income. But I could have done the debt service coverage ratio loan, because I had plenty of cash in the bank, and I had really good credit, and it would have been a great property. But no, hey, you don't qualify for the regular loan, bye. So having knowing the questions to ask, which is challenging, right?
Asking the right person the questions.
Yeah, and then it's the right person, somebody who's looking for a way to get things done. And, hindsight 2020, but, things like that, it's, somebody who's looking for the ways to say yes rather than the ways to say no is it can be helpful.
Well, giving you options, right?
Yeah.
That's the key word here.
Yeah.
And a lender or a mortgage broker like Nick, where he will give you what your options are, he will drill it down until the end. I mean, yes, there might be situations where there aren't any options, but he'll go through the process until he gets to the point where an option might work for you. I've seen that with him.
Yeah.
I've gone through that with him. So I definitely know that. So let's talk a little bit about refinance.
So rates.
What is the market like now?
Yeah, so rates are at a point now where lots of people are hoping that, hey, maybe I'll be able to get a lower rate in the future, because they were astronomically low for a couple of years there.
Ridiculously low.
And then we are bearing the brunt of that now, and they've jumped up along with housing prices. So if there's an opportunity to refinance for many of the people who have bought in the last 12 months, that's going to be very welcomed news. So when you refinance, you are paying off your old loan. The loan that was originated and started in November of 2022 is paid off with a new loan in whatever month it is. And that new loan will have the lower market interest rate. So there's costs always associated with that. The government takes their cut. You'll pay some lender fees. You're going to pay for an appraisal. Typically, again, it can get waived in certain instances if certain things work out, and it's kind of a black box. So I don't really have an answer on, hey, why does appraisal get waived or it doesn't? But
depends on the individual situation.
Yeah, it depends on the house and the automated system that gives it the thumbs up that, hey, we're extremely confident in this value. But so there's going to be costs. So you always want to look at an appraisal based on the return for those costs. So if it's going to cost you, let's just say $5,000 as a simple example, and you're going to save $250 a month, it's 20 months before you get that $5,000 back. Did I do that right? Yeah. Hopefully.
Let's see who can check you. That's going to be our task. Write a note if he's wrong.
Yeah, then you'll be the top commenter for Sherron. You'll get the award. But with that, you always want to look at it from that point, because you'll get lots of calls and letters saying, Nick, congratulations. We think we can save you this much money on your mortgage payment in the mail. And you might be able to, but you want to compare that to the costs, because that will be, even if you don't pay it out of pocket today, your loan is going to go up. They can roll it in. So it won't necessarily be cash out of your pocket, but you're going to have to pay that back one day or another.
So just quickly, should the mortgage rate right now deter you from buying the home if you're ready in every other ways?
No, I mean, it's actually a great time to buy. If it's obviously you have a need or a want to move, the payment is something that we talked about earlier, where it's not going to stress you out, because obviously when you buy a house, you'll get typically a 30-year fixed rate. So you know that that's not going to change. Your actual loan won't get any worse. Your taxes and your insurance may change, but outside of that, your loan stays the same. So if all right, here's where my payment's going to be, I'm okay with it, there's only upside if you can refinance. And the good news is, right now, if you can qualify with the higher housing values, with the higher interest rates, congratulations, because there's many people that don't.
Right.
And so there's a smaller buyer pool, because some people just don't qualify. Then there's a bunch of other people who are hesitant, and they're staying out of the market until, and I read something recently, I don't know where it was, but they said about 2/3 of people surveyed said, I just won't buy unless the interest rate is 5.5% or lower.
They're missing out on the market.
But it's a benefit to the buyers that are here and ready to go now, because
they have more choices.
There's going to be way more people hunting for that same house if and when rates drop. So when rates drop to 5, when rates drop to 5, there's going to be a lot more buyers. There's going to be a lot more competition. You might not get an offer accepted with a smaller down payment like you could now. You might not be able to negotiate with the seller on price or ask for credits back to help you with your closing costs. So there's a unique opportunity right now. If everything else lines up, you can buy, you're in a little bit more of a favorable position. And then, of course, if that rate drop does come, you refinance.
So that's good to know. I just wanted to make sure that people are not, when they're ready to buy, it's something they should not be deterred by interest rate. Right now, I believe when I bought my first home in 2000, it was 9.5%. So historically, this is a reasonable interest rate If you're in your 40s like me, you'll remember. If not, you can look it up to know. But the last thing I want to talk to you about, Nick, is really important, and it is about when you are financially literate and you understand what's happening in this world. You know, when people are around, there's so much people out there that are talking about financial literacy, that are working in the mortgage industry or in the accounting industry or any of the financial services industry, and there's so much fraud out there.
Yeah.
So, you know, one of the things I said was, you know, you make sure you have that conversation, make sure you're working with your people, make sure you are proactive and doing your due diligence in any aspect of anything that you're doing in your financial life. So I just kind of wanted to touch on what you're seeing out there in terms of, you know, people being taken advantage of, and because they're not being financially literate and thinking and planning, you know, they get taken advantage of even more.
Yeah. You know, with the way the market is down here, housing is, for, like I said, a decent percentage of the population, it's challenging to buy. So people are going to be, you know, more apt to go for something that seems really, really good. And I would always challenge people, it's, hey, when something seems too good to be true, it probably is. And you want to double check it and triple check it. And in the mortgage world, it's extremely regulated. And you can check so many things about a lender that you are talking to. And you can look them up on the NMLS, and you can see their history as a licensed loan officer. Anybody who's talking to you about interest rate, payment terms, loan types, they're licensed. They need to be. So I always recommend, you know, if you're unsure about it, check there first, because that's like a government database. And then you can Google them, look for reviews. Make sure you're calling, like you said, conversations, of course, you can go through email, but talking to somebody over the phone, you can make sure you generally know who you're talking to. You can get a good feeling for if they're coming from a position of knowledge as well, you know, because some people might be just misguided, and you can hear that in the tone of their voice. You know, hey, does Nick really seem like he knows what he's talking about, or is he just spinning a web? And so I would highly recommend doing your research and you know, pursuing things from a position of, you know, trust but verify.
Trust but verify.
Build that trust, and you know, when you're sending wires, which is the way that most money moves around in a real estate transaction.
Absolutely.
You press go, it's gone. And I recently had a buyer who was able to purchase a house, unfortunately, because something happened with the previous buyer and their money went to the wrong spot. And I don't know all the details about it, but that's the only reason that my buyer was able to purchase the home. So there was somebody who was in a terrible position because on closing day, their money went to the wrong spot. So I always say you're going to, if the title company gives you the wiring instructions, you're going to call them and read it back and, you know, hey, 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, great. This is my amount. Verify it over and over again, because
confirm that they've received it.
Yeah.
You know,
and, you know, once you press go, I mean, once confirming if receipt it's already gone. So it's before you press go, it's verbally and in writing. So it's, hey, I'm going to confirm one more time. This is it. But, you know, there's an opportunity for a lot of money to be moving hands, and people who are, you know, trying to commit fraud, they know that. They know a title company on a good day might have a few $1 million coming in out of it. And if we can figure out how to get at it, by the time anybody realizes anything, we've got enough to consider it a successful thing. So, you know, there's a target, and just being aware of, hey, knowing things are emotional, knowing that things are high value, there's a target on these type of transactions. So being aware of, you know, potential for fraud is super important.
And again, one of the ways that you can avoid fraud is recognizing it before it happens to you. It comes about, I see so many emails come to me saying this or saying that. When I investigate it further, it's fraud. Mm-hmm. So you want to make sure that you're not just taking everything for the face value of it, that you are doing your research, you're evaluating, and you're vetting the people you are working with. It is so important that you take advice from qualified people who know what they're talking about, people with experience, getting the right referrals. And that is one of the best ways to avoid fraud and getting the best for your money.
Agreed.
One last thing I wanted to talk to you about is there's a program here in Florida that it does. So there are instances where we do have programs that are working for us, but when something is too good to be true, it usually is. So there is a program out here though that we are working with now. That you want to talk to us about, the Hometown Hero program?
Yeah, Hometown Heroes. So the state of Florida last year came out with this program. In most down payment assistance programs prior to this, at least in the state of Florida, were heavily dependent on income. And it was restrictive to where you needed to be earning less than 80% of the area's median income. So it was restrictive in that regard. And they were challenging to get. There were limited funds. It was
basically
almost like hitting the lottery, better odds than that. But it was a big deal if you got it. And so Florida came out with this program. They funded it with, I believe, $100 million last year. And there's still some money left in it. And it's a pretty broad category of, it's based on a few things. You have to have the credit score to qualify, the debt to income ratio, all that stuff. The income, fortunately, was much higher. Like in Palm Beach County, the income that you could have was close to $10,000 a month on your loan application. So other down payment assistance programs, they'd say, well, if Nick makes, let's just say $9,000, so he's underneath that limit. But if his wife makes $5,000, even though she's not on the loan, their household income's too high, no go.
No go.
Now it's just the income that's on the application. So a lot more people qualify. And then it's for a broad category of jobs. Veterans, firefighters, teachers, police, sheriffs, and then lots of licensed roles in the medical field. And it was pretty much all, you have to be certificate-based or licensed to do it. And it would give you a interest-free, payment-free second loan, which can be used to help you with your down payment and your closing costs. So they would give you 5% of your base loan amount. So in a simple example, if you had a very simple, so my brain can calculate it. If you were a veteran doing 0% down, so your $400,000 house is a $400,000 loan, they would give you $20,000 as a second loan with no payment. It's due only when you sell, refinance, or otherwise pay off the loan. You have to pay it back to the state, but it's not getting any bigger. So they would give you $20,000 to cover your closing costs. Typically, you're not going to have $20,000 of closing costs. So you can take the excess and actually put it towards the principal on the first loan. And it's a really great program. It capped out at $25,000 of down payment assistance. They just renewed it. It'll be coming back. They're going to renew it with another $100 million, and they're going to expand the job categories. They haven't told us what, but there'll be more people that qualify, and the program's going to be around for, I would imagine, better part of next year.
Quickly tell us who you are again and where you work and all that good stuff.
Yeah, so my name is Nick Anaspigian. I work at a company called Movement Mortgage right here in Wellington, Florida, and it's a great company that loves to give back to the community, and they serve their customers really well. And I'm just really proud to be part of that company and helping out so many families on a monthly basis. That's what brings me this satisfaction in the job is, it's trying to make that process for people as stress-free as possible. There's always going to be challenges, but it's awesome when I can meet people on the closing day and see the smiles and congratulate them on their new home.
So yes, Nick, if you would like, Nick is, whether you're looking for your first home and looking for down payment assistance from one place or another, or you're looking at different investment properties, where you're looking to be getting a mortgage for an investment property or a rental property, contact Nick. I've gone from one end to the other end with him. So he is definitely knowledgeable and able to answer your questions. But in order for you to have questions, you need to be financially literate about things. So definitely do your research and make sure that you understand all the stuff that we've talked about today, and give Nick a call if he can be of service to you. This is the Modern Savvy CPA. Next time I will see you.